Welcome to Capital Insights. I think it's a bit of an understatement to say that the financial markets have been a little bit bumpy this year, a little bit of volatility. In fact, over the first 6 months of this year, if we look back, the S&P 500 stock market began the year at 2,058. And if we look at the change every single day in the S&P for the first 6 months of the year, one day it's up 5, the next day it's down 10. If we added up all those points, the S&P traveled 1,544 points in the first 6 months of this year. And at the end of the first 6 months, the S&P was up 5 points relative to where it began the beginning of the year. In other words, it was pretty much a round trip to nowhere, but a lot of up and down in between. After a while, it makes you feel seasick. The up and the down and the up and the down. And it feels like a lot of volatility, even though in reality, the market this year has only gone up about 3.5% and down at about 3.5% and traded in this band for 6 months, 7 months now. Actually, it hasn't been that volatile at all, but it feels a lot like it. And when this is happening, the headlines are kind of on the stock market. But what I really wanted to talk about today was the bond market, sort of in the background, in the shadows, not as much limelight as the stock market given the volatility this year. Well, the fact is that there's been some volatility in bonds too, and it's really happened globally. In fact, in probably April or May, the 10-year German government bond got down to a yield of 0.05%. That's 0.05%. About 3 weeks later, the yield was 1. That was a 20-fold increase in interest rates in 3 weeks. Is that volatile enough for you? That's a lot. We've seen some of the same things in the U.S. bond market too. Earlier this year, at the lows, and this was in February, 10-year Treasury was 1.67. It hit a high at 2.45, maybe 3-4 weeks ago. So again, we're seeing volatility in bonds too. The reason I'm bringing this up today is that if we look back historically, bonds have always acted as a, if you will, safe haven refuge when we've gotten into rocky times for stocks. People have run to the bond market. It's been a safe place to be. As we all know, government bonds are risk-free, aren't they? Well, again, as we look at the stock market, it's been about a 6-year bull market now. It's one of the longest bull markets in the history of the market itself. But for bonds, it's been a 33-year bull market, much, much longer than the bull market for stocks. In fact, 5 times longer. The last time we saw a bear market in bonds was in the 1970s. Most investors today, and believe me, you better have some gray hair, were at their high school prom the last time this happened. So how many folks today have experience managing through a potential bond bear market? And the answer is not many. But one of the reasons we're bringing this up is because as we look forward, and this isn't happening today, but as we look forward over the next few years, we do not believe bonds are going to be the safe haven refuge that they've been in the past. Why? Well, for one reason, it's been a 33-year bull market. These things just don't last forever. The second reason is a lot of central banks around the planet have lowered interest rates to 0. How much further from here on the way down? And the answer is not much further. We're already there. And when interest rates go up, the price of existing bonds goes down. But there's another issue, and you know some of these issues. About X months ago, in March of this year, we did a video on Greece. Well, over the last month or so, Greece has been in the headlines. We all knew 3 years ago, 4 years ago, Greece wasn't going to be able to meet their debt payments. Everybody knew this. It's not a big surprise by any means. But what's happened in Greece recently is time's up. They've run out of time. A little bit behind the news, because Greece has been so much at the front. About 3 weeks ago, Puerto Rico came out and said they could no longer pay their government debt either. In fact, the governor of Puerto Rico put it very, very well. He said, this isn't about politics. It's about mathematics. We can't pay it back. Is this some new news? No, it's not. Everybody knew about Puerto Rico 2 years ago. And the panacea over those last 2 years has been to borrow more money and hope everything was going to work out okay. But what's happened to Puerto Rico in the last 3 weeks? They've run out of time. Chicago. About 3 weeks ago, Chicago was downgraded to junk bond status. Why? It's because a federal judge came out and said they couldn't renegotiate their pension payments. Pension issues have been an issue for Chicago for years now. This is not new news. Everyone has known about this. It's been going on for years. But what's happened to Chicago in the last 3 weeks? They've run out of time. So as we look at these three events, we look at Greece, we look at Puerto Rico, we look at Chicago, and basically the downgrading of Chicago is a bit of a seminal event because Moody's is basically reviewing all of their ratings for some of the large municipalities who have pension obligations. But these are three government entities who have lived beyond their means. They've borrowed too much money. They've made promises that they are not going to be able to keep. And the commonality between all of them in the last month or two is time is up. We've known about all these issues. Nothing has been done about these for 2-3 years now. Time is up. Will they be alone? No, they won't. Look at the very, very large government balance sheets across planet Earth. Look at the Eurozone. Look at Japan. 300% debt to GDP and a ton of social promises that lie ahead. China. The United States is actually the same way. We know this. This is not new news. The pension difficulties aren't new news. Social Security isn't new news. Medicare isn't new news. But we still have some time. But the issue is, and I think it's very important, when we look at Greece, Puerto Rico, and Chicago, we're looking at three government entities here who've run into trouble. And what has the market done in response to this? Well, what it's done is it raises their cost of capital because they're now troubled borrowers. So interest rates have gone up for all of these three entities. That's exactly how the capital markets deal with deteriorating balance sheets. So as we look forward, and again, remember, over the last 30 years, we've had this bond bull market, this huge wind at our back with interest rates coming from 15% in 1981 all the way down to 1.5% on 10-year treasuries in the year 2012. Huge bull market tailwind, huge dynamic for price gains over time. Will that happen again over the next 10 years or 20 years, especially since interest rates are near generational lows? And the answer is it won't happen again. Bonds are going to be riskier ahead than they have been in the past. One last little fact that I think is very important. As we look at total asset class size across planet Earth, there is 2.5 times as much money invested in bonds as there is in stocks. What happens when the bond market someday starts to turn negative, when the dark clouds come out? Where will those assets be reallocated to? Because again, for a lot of the big pension funds that are out there, they can't just sit there and watch their bond position deteriorate. So is it that the world's about to come to an end for bond investors? Not at all. What we're suggesting to you, though, is that amidst this volatile market, this feel of increased volatility, especially in stocks, the day-to-day up and down, don't take your eyes off bonds. Very, very important globally, and we're suggesting to you that bonds will not be the safe haven assets ahead that they have been in the past, really based on a lot of balance sheet deterioration among the major government entities, among states, municipalities, etc. It's going to be a very different world. We've suggested to you many times in these videos in the past, risk management is absolutely the key in successful investing over time. Remember, that applies to stocks, but that also applies to bonds as we move forward. We very much appreciate your time and being with us today. On behalf of the entire team at Capital Planning Advisors, thank you so much. I'm Brian Pretti. We'll see you soon.